I'm very happy to have with us CA Shri Manish Iyer, a renowned expert on GAAP, IndAS, and IFRS, here to explain on a particular IndAS standard of classification of financial instruments. Shri Manish Iyer is a director of GAAP Advisors, a firm which he started several years back. He had served as a deputy director in the technical directorate department of the Institute of Chartered Accountants from 2013 to 2016. He was in charge of the Accounting Standards Board and the technical directorate of the Institute of Chartered Accountants of India when he resigned on May 2016. He played a very important role in the development of IndAS and liaising with the Ministry of Corporate Affairs, Government of India, for the IndAS to be notified and made applicable. He has been part of groups constituted by bodies like RBI, IRDA, etc., for framing regulations for financial statements on IndAS for banks and insurance. Till September 2013, he was practicing under the banner Manish Iyer and Company Chartered Accountants. Mr. Manish Iyer has so far delivered nearly 4,500 plus man-hours of presentation on IFRS, US GAAP, Indian GAAP at various forums across India and abroad. Qualified as a Bachelor of Commerce, he is also a fellow of the Institute of Chartered Accountants and a certified diploma DISA of ICAI, as well as diploma of financial reporting from ACCA. He has authored several articles and columns in professional journals like the Chartered Accountant of the ICAI and the Ahmedabad Chartered Accountant Association Journal on the subject of IFRS, IndAS, and Indian GAAP. He is very sought after for his expertise by professionals across the world to give considered opinion on application of IndAS, Indian GAAP on various transactions, and has extensive exposure in IFRS compliance in almost all industries, including BFSI sector. Believe me when I tell you that Manish Iyer breathes accounting standards. He has them for breakfast, lunch, and dinner, and also in between for snacks. He's got a weekly newsletter which is has been publishing for the last year or so, and it is available free for all subscribers. You need to get into the LinkedIn and search for it. I will also post the link to that for your convenience. And in addition to that, I'm very happy to add that Shri Manish Iyer distributes prizes based on competence of the questions answered by any of the participants, and then this he does on a regular basis, almost every week. So on technical, and plus he also gives access to his detailed website for free. The repository is having nearly 5,000 to 7,000 articles and questions on the applicability of the standard in various kinds of situations. He is sought after internationally, be it the Americas, Brazil, or the Europe, London, or any other place on specific treatment of transactions, complex transactions. So we are very fortunate to have with us and guide us on this classification, recently introduced classification of financial instruments. I warmly welcome Shri Manish Iyer for this evening. Over to you, Manish Iyer. Welcome.
Thank you so much, Arun, for a wonderful, somewhat hyped introduction. But I am flattered by such an introduction. Thank you so much.
Just to add on the presentation part, friends, kindly do not ask any questions out of turn. Please raise your hand, and then I will call out the names you can ask the questions in particular, because there is not going to be a Q&A at the end. It is going to be part of the session. And so you can come out with the question if you have any and raise your hand. And I myself and Charlotte will ensure that you are heard and you are answered by Shri Manish here.
So shall I share my screen?
Yes, please. Yes, please.
Is the screen visible?
Very much.
Okay. Thank you so much for inviting me for this presentation on a particular topic of financial instruments, that is classification of financial instruments. Normally, what happens is I have found that people speak on entire standard just in 1 or 1.5 hours. Whereas here we are discussing a particular topic of the standard for about an hour or so. And so I am glad to do that, because that gives some justice to the topic as such, you see. As you can see, classification of financial instruments, the way the title I have written, okay, is something. So one is you can see upwards very clearly, okay, but there is a reflection going down which is not very clear, okay. So this is what in financial instruments actually something is always hidden. And so if you say that if in fact it is my own experience that if I say that I have read the financial instrument standard, that means I have not properly understood that standard. And if I say, okay, no, I have understood the standard, that means I might not have properly read the standard. So that is the complexity of financial instruments. And the same is with classification also. So something remains always hidden, and you have to apply a lot of judgment, and estimations are involved. We will, actually this opportunity to present, actually it gives me a learning. It provides me a learning opportunity to learn from you all on various issues that you face. Okay, we may discuss that. And please don't be annoyed if I am not able to answer now your question, because some of your question could be very technical or could be complex, and it might require some further review and thinking, or further reading as such. Okay, but do feel free to ask your questions. Okay, I move ahead. So Mr. Arun Kumar has already introduced me, so I need not spend time on this. So okay, why we need a classification of financial instruments? Anyone? What is the importance of classification? Why are we discussing this classification of financial instruments?
Probably for presentation in the financial statement.
Yes. Basically, classification governs subsequent measurement and presentation. Okay. So how the financial instrument is measured and reported in your balance sheet is what that is governed by the classification of financial instrument. So that is why we are. It is very important to understand the classification of financial instruments. Now I will start with some basics. Okay, we won't spend much time, but going initially from the basic is very important. So what is a financial instrument? So basically how a financial instrument is defined is that financial instrument is a contract between parties giving rise to equity or financial liability for one and financial asset for the other. So for the issuer of financial instrument, it is either equity or financial liability, and for the holder, it's a financial asset. Okay. Equity financial liability classification is governed by IndAS 32, whereas the classification of financial asset is governed by IndAS 109. But to understand the classification of financial asset, we need to also understand the classification of equity and liability. Okay, therefore I will discuss both the things, classification of equity and financial liability, and also classification of financial assets in this. What is equity, what is financial liability, we will understand in the next slide. So this slide basically provides you that how the assets and liabilities are classified. Okay, equity, there is no further classification. For financial liability, or there are three classes. The one is amortized cost, one is fair value through profit loss, and the third one is others. That is the multiple categories into that, in that others. In financial asset, again, we have to see whether that financial asset is an equity instrument or a debt instrument. Okay, to see that, again we go back to IndAS 32 principles of equity and financial liability classification. Okay, this is where we come here. So to understand whether financial asset is equity or debt instrument, we have to come here again. Okay, so as a holder also, I have to think from the perspective of an issuer, that had I been an issuer, would this be an equity instrument or a debt instrument? If it is an equity instrument, I have two classes, a fair value through profit loss and fair value through other comprehensive income. If it is a debt instrument, I have three classes, fair value through profit loss, fair value through other comprehensive income, and amortized cost. Okay, so when these classification when debt instrument is classified as at FEPL, as at FEOCI, as at amortized cost, we will see in later slides. This slide only provides an overview of the entire classification of financial instruments. Okay, now classification of financial instruments by issuer. So whenever an issuer issues a financial instrument, then that issuer has to classify that instrument into either liability or equity. So what is a financial liability?
Sorry, where you have an obligation to settle on a future date?
Yes, very good. So whenever there is an obligation, not any obligation, it has to be a contractual obligation, because as I you see a financial instrument is a contract. So it has to be a contractual obligation, and that contractual obligation has to be to pay cash. Okay. So any contractual obligation that requires you to pay cash, or or it requires you to pay in your own shares, okay, the entity shares, in lieu of cash. It could be that the contract could be structured in such a way that, okay, we don't say that, okay, you pay cash. Yeah, the contract is says that you pay in shares. Okay, you deliver shares, but then that delivery is in substance in lieu of cash. So then also it becomes a financial liability. Okay, so whenever there is any contractual obligation to pay cash or shares in lieu of cash, then it's a financial liability. And what is equity? Equity is nothing but assets minus liabilities. So whatever the residual interest in the entity, whatever remains after deducting all liabilities from assets, is equity. So equity, by this definition, you can understand that in equity there cannot be any variation. Okay, if there is a contract to issue shares, okay, and the value of those shares, the number of those shares or the price of those shares at which you will issue, at which you will be delivering, is not fixed. If any of these two legs, there are basically two legs. Okay, one is the number of shares and one is the price per share. Okay, if any of these two legs is variable, it has a potential to vary down or up like this, then it is a liability. Why? Because then in that case you are actually issuing shares in lieu of cash. Okay, so in substance you are actually paying cash in that case. So therefore it becomes a liability. Only when it remains fixed, okay, both the legs are fixed, then you can say that it is an equity transaction, because then it represents a residual interest. It has no movement, it remains fixed. Okay, there is no movement. The interest is represented by the residual part only, then in that case. So that is the difference between liability, financial liability and equity. Now the standard requires that on initial, at the time of issuance, on the date of issuance, you classify this into financial liability and equity. On the date of issuance you have to do, and that classification is not revisited. Okay, you don't revisit that classification at the end of each reporting period. Saying that, okay, if there is any option to issue shares, and you again see at the end of the reporting period what is the probability of that being converted, that is not done. Whatever is the classification, you assess at the inception, that remains as it is. If you want to change, then it's a prior period error. So you may say we have done an error and do that accounting for changing the classification. Now there can be instruments which are called compound financial instrument. Okay, what is a compound financial instrument? Compound financial instrument is an instrument which has both equity and liability components. Okay, so on one, so basically your convertible bond, convertible debenture, convertible preference shares, which are convertible into fixed number of shares for a fixed amount of cash. Okay, then these instruments are compound financial instrument. Okay, they may be entirely equity also. So let's say there is a non-cumulative convertible preference share, and that conversion is on a fixed is for fixed number of cash and for a fixed amount of fixed number of shares for fixed amount of cash. Okay, so the that condition is met of equity and it is non-cumulative. So the dividend, the dividend is also there is no obligation to pay dividend to the preference shareholders in that case. It is at the discretion of the issuer. Then in that case, convertible preference share will be classified entirely as equity, because it has no liability and equity component. But if it is, let's say, the dividend is cumulative, okay. So, but then there is a it has both the components. The conversion component is equity, whereas the dividend component there is an obligation to pay cash. Okay, so in that case, also it becomes a in that case the dividend component becomes liability, and therefore it's a compound financial instrument. So therefore we need to understand in an instrument that, okay, whether both the components equity and liability, and separate those components. How to separate is basically a measurement issue. I am not going into the measurement of the financial instruments here, because then we will be jumping into some other discussion. I am restricting myself here to only classification of financial instruments. So classification of the financial liability, how financial liability is classified, this is in IndAS 109. Okay, so IndAS 32 only governs whether an instrument issued by an entity is whether it is equity or a financial liability or a compound financial instrument. That's all. That is what is governed by IndAS 32. In IndAS 109, it governs the recognition and measurement of financial assets and financial liabilities. So the classification of financial liability, this is IndAS 109. It says that all financial liabilities are classified subsequently measured at amortized cost, except so so these are as we saw in the this slide, there are three classes. Okay, amortized cost, FPPL, and others. So this slide covers amortized costs and others. So what in the IndAS 109 says, all financial liabilities are subsequently measured at, are classified as subsequently measured at amortized cost. Okay, but there are certain exceptions. For those exceptions, the others category will apply. Now, what are the exceptions? Financial liabilities which are mandatorily measured at fair value through profit loss. Which are those financial liabilities? Those are derivatives and contingent consideration in a business combination. For that, the subsequent measurement is at amortized cost. Then there can be some financial liabilities that arise on transfer of financial asset. So you transfer a financial asset to another entity, but because of the derecognition requirements of the standard, that financial asset is not derecognized. So the standard says that whatever amount you have received for that transfer, you consider that amount as a financial liability. So those derecognition requirements also provide for how you measure those financial liabilities. Okay, so if there is any financial liability that arises on transfer of financial asset, you measure as per the derecognition requirements of IndAS 109. Then if the contract is a financial guarantee contract, then you measure at the higher of loss allowance or unamortized commission. So when an entity, when a bank issues a financial guarantee contract, it asks for some commission, for that. So basically the initial the commission is the fair value of the financial guarantee contract, and then unless there is a the loss allowance increases, there is a probability of credit losses to occur on the financial guarantee. You keep on amortizing that commission income, okay, as per IndAS 115. So therefore IndAS 109 says it is measured at the higher of loss allowance or unamortized commission. Then there are certain loan commitments. So loan commitments, all loan commitments are not recognized. Okay, here we are discussing only those loan commitments which are recognized. Loan commitments are as such scoped out of IndAS 109, except certain loan commitments which are scoped in. Because we are here discussing only the classification of financial instruments, I will not go into much into the scope part, but I can explain here in brief that okay, which loan commitments are recognized. Let's say you commit a particular person that I will give you a loan, okay, after so many days, for at such and such rate, and I have a practice of selling that loan commitment to another entity, to another bank, to ensure my liquidity is not disturbed. Okay, therefore, so basically, I'm in the practice of originating and selling loan commitments. Then I will have to recognize that loan commitment as per IndAS 109, or I make a contract that okay, I will give you a loan after let's say 3 months at 10%, but then after 3 months we will settle the loan, we will settle net in cash, in the sense that okay, whatever is the difference in the interest rate, if you benefit, I will give you that much amount, or if I benefit, you give that much amount. So it is settled net in cash. Okay, so then it becomes a derivative, and therefore you have to recognize that loan commitment. Also, in loan, if the loan commitment is at a below market rate, so any loan commitment at below market rate is in substance a derivative. Okay, so therefore as a derivative you measure at fair value through profit or loss. Okay, so but when the loan commitment is not a derivative, that loan commitment is measured at the higher of loss allowance or unamortized commitment fees. You have received some commitment fees, you keep on amortizing those commitment fees, okay, over time, as per the principles of IndAS 115. But if the loss allowance on loan commitment increases, okay, let's say you committed and the credit risk of that particular party to whom you have committed has gone up. So naturally, you have to keep your commitment, and because you have to keep your commitment, your losses might also go up. So you have to recognize a loss allowance on that. So if you have to keep on comparing whether the loss allowance is higher or my unamortized commitment fee is higher. Whichever is higher, you have to measure at that. So that is the others part. Okay. Now the final classification of financial liability at fair value through profit or loss. So there is an option to designate. So an entity can designate a financial liability at fair value through profit or loss. Now the question is, okay, whether this designation is an open choice. No, it is not an open choice. Okay. So when can this designation happen? If such designation eliminates or significantly reduces a measurement or recognition inconsistency. So what does this mean? So this means that let's say you have a financial liability, okay, and that is linked to a financial asset, okay, and that financial asset is basically measured at fair value through profit or loss, okay, because of the requirements of IndAS 109, that financial asset has to be measured at fair value through profit or loss. Now if I go back here, because that financial liability does not fall in any of these exceptions, I have to measure it at amortized cost. So there will be a mismatch. Okay, my asset is at fair value through profit or loss, whereas my financial liability is at amortized cost. But both are linked. So my profit loss will be impacted, and the impact will not represent the way I am managing my assets and liability. You see, basically the financial statements must represent how the entity is managing the assets and liability. Okay, if you go through IndAS 117, insurance contracts, the latest standard, IFRS 17 or IndAS 117, which is not yet notified. Okay, but you can say the exposure draft. So how it goes, the entire standard is based on the actuarial principles. Okay, it says the CSM is your the profit is your income. Okay, and you have to measure, you have to group the insurance contracts. Each individual contract you need not, you should not recognize. Okay, so you go on a group basis. There is annual cohorts. So how so basically it is how the insurance companies manage those insurance. So this is how the standards are developing now. That is where the challenge is. If you ask me a one-line definition of IndAS or IFRS, okay, then I will define IndAS or IFRS as management's call and auditor's challenge. So under IndAS and IFRS, management has to keep taking calls. Okay, at each and every step there is a judgment, and based on that judgment they have to take a call. Now the auditor, for an auditor, you see, he has no other way but to challenge that call. Okay, so therefore as an auditor, if a person is an auditor, he has to be aware of the standard more than the management to be able to challenge the call. Okay, that is where the issue is, that okay, whether as an auditor, am I double aware of the standard than the management to challenge the call. Okay, so this is what is the challenge is coming in IFRS and IndAS. So now we move to okay, we were discussing this. So this is the first thing. If such designation eliminates or significantly reduces. Then the second is, or a group of financial liabilities and financial assets is managed and its performance is evaluated on a fair value basis. So basically, I am a let's say a financial institution. Okay, so I manage all my financial liabilities and financial assets on fair value basis. Then if I do this amortized costing, just because the standard is saying that okay, you because it does not fall in any of these exceptions, I have to mandatorily measure it amortized cost, then the standards will not represent the way the entity is managing those assets and liabilities. So therefore, if a group of liabilities and assets are being managed and its performance is evaluated on fair value basis, and there is a documented risk management or investment strategy, and the information of about the group is provided internally on that basis to entities key management personnel, then you can measure those group of financial liabilities at fair value through profit loss. So this is the option. Now this option, so when I say it's an option, okay, then at that moment one sees para 13 of IndAS 8. IndAS 8 is accounting policies, changes in accounting estimates and errors. Okay, so what para 13 says that if any requirement of a standard permits a choice of accounting policy, okay, then whatever accounting policy the entity selects, it has to apply uniformly to all similar transactions, events, or conditions. Okay, so but then this choice is not an open choice as envisaged in para 13. This choice is a restricted choice on an instrument to instrument basis or on a group basis. Okay, it's not an open choice that I say, okay, for these sort of financial liabilities, I measured fair value through profit or loss and I apply this to all similar. No, this is not done. Okay, this is not an open choice. It is a very restricted choice. So we will understand some of the application. Okay, so this is the issue. On January 1, entity X writes a put option for 1 lakh of its own equity shares, for which it receives a premium of 5 lakh. Okay, and there is an obligation to take delivery under the terms of the option. Entity X has an obligation to take delivery of its own shares at an exercise price of 2,20,000, and the settlement is through physical delivery of shares. So how you account for this? So first is you see when entity X writes a put option, okay, then what is happening? You are basically giving them 1 lakh shares for a fixed amount of cash. Okay, so there is a fixed number of shares and fixed amount of cash here. So that contract becomes an equity contract. So you account it as bank debit to equity. Okay, you are receiving 5 lakh. So bank debit to equity. So that is an equity contract. But then at the same time, you are undertaking an obligation to deliver shares for cash. Okay. So any obligation to basically pay cash. Okay, you are what you are doing is you are saying that okay, I give you an option to put back those 1 lakh shares to me in 1 year, and I will pay you 2,20,000 for that. So I am also taking an obligation to pay cash for that. Okay. So in that case, I have to record a financial liability for that, because I have an obligation to deliver cash. Okay, pay cash. So, and that financial liability, how is it measured? It is measured at fair value. Okay, that is again governed by IndAS 109 measurement principles. Okay, now however, IndAS 32 says it is initially measured at present value of the redemption amount, which is year 2 lakh. So you measure the financial liability at 2 lakh. So this contract gives rise to both, first equity and second a liability, both. Entity issued a CCPS. CCPS is compulsorily convertible preference shares. Under terms of CCPS, these instruments are compulsorily convertible into equity shares in the ratio of 1:1. Okay, so the number of shares in which they will convert is fixed. Okay, the amount is also fixed. Okay, so here the fixed for fixed condition, the both the legs, amount of share, number of share, and the cash amount per share and number of share, both are fixed. It is not changing. Okay, but then the agreement has an exit clause, which wherein the issuer needs to buy back the CCPS at a specific IRR of 25% at the option of holder. So that means that the holder can come back to me. Okay, if I have issued that CCPS, the holder can come back to me and say, you please take this, all these CCPS and give me cash. And while giving cash, I have to also ensure that it gives him an interest of 25%. Okay, so that means there is an obligation. So therefore, this becomes a liability actually. So this is not an equity. This is a liability, financial liability. Now, White Limited, having functional currency of rupee, issues rights to acquire fixed number of its equity shares for a fixed amount of cash. Okay, in Singapore dollars, to a select number of shareholders, whether the instrument is liability or equity. Any view on this?
Equity.
Okay. Any other view?
Yeah, okay.
May I know the reason, sir, for they
I thought it's fixed. It is the number of equity share becomes fixed, and as well as the value being fixed, right?
Okay. So here basically the contract says that it is to acquire the issue rights to acquire fixed number of equity shares for a fixed amount of Singapore dollars. Okay, so but my functional currency is a rupee. Okay, so when my functional currency is a rupee, the Singapore dollar becomes my foreign currency. Any currency other than functional currency is a foreign currency. And I have to translate all my transactions into functional currency. So there is a variability, there is a foreign exchange risk here involved. Okay, so when this sort of a transaction is done to a select number of shareholders and not to all shareholders on pro rata basis. So it is a sort of a private placement. So it's not a pro rata sort of thing. I am not issuing rights to entire all the shareholders, but I am going on as I am issuing only to select number of shareholders. Then in that case, it becomes a financial liability. Okay, but when I am issuing the definition of financial liability as an exception, that if I am issuing a rights issue, okay, if I am having a rights issue which is in foreign currency or which is in any currency, functional currency or foreign currency, and it is on a pro rata basis to all the equity shareholders, then it is in substance an equity transaction. Okay, this is an exception to the definition of the liability. In the first case, it becomes a financial liability. Why? Because the issue is to a select number of shareholders. It is not on pro rata basis to all shareholders. Okay, so therefore the foreign currency risk is considered here for classification, and because there is a the value is not fixed. You see here there is a variation happening because of exchange risk element, and therefore this is a liability. But in the second case, there is a variation, but that variation is not your expense or income. It is your equity because it's a rights issue. Okay, when you say it's a risk, what is a foreign currency risk? When it impacts your profit loss. This is not impacting your profit loss in that case. Okay, so therefore this is equity transaction. In the second case, so therefore the financial liability definition has an exception to that. Okay, and had that exception not been there, then or in the second case also, because of foreign currency element, it would have been a variation. Okay, and because of that variation, it would have been a financial liability. But in substance, what is happening? I am basically issuing to all my shareholders only. Okay, there is no outsider, and it's on pro rata basis. So in substance, basically, I am doing an equity transaction. So therefore, this exception is there in the definition. Now we come to classification of financial assets.
No, I have
Okay.
Can I ask you a question, please?
Yes.
Can you go back to the previous slide, please? Now, when you say that you have issued fixed number of equity shares, so you are the issuer, right? For a X amount and in a foreign currency, right? So when it's a liability, so when does my equity go up, right? So I am issuing certain number of shares. My equity share capital goes up by a certain value. So that's why I'm a little bit confused about when you say it's a financial liability. Are you saying that at inception it will be financial liability, and then when the issue process is completed, then you move into share capital?
Yes, because because the classification is done at inception. You see, that is what I
was answering that what color it will take subsequently when all the process is completed. That's why my answer was to that. Yeah.
So once the process is completed, then there is no scope for variation. You see, the amount of cash becomes fixed. You see, the amount that you are going to receive in a functional currency, there is no variation. When you are issuing this and the date you are allotting, okay, or you are receiving cash, there can be a variation in the amount. Okay, so that variation creates a liability aspect. Okay, so
Okay.
so inception, it is a financial liability. Subsequently, when the amount becomes crystallizes, or you say fixed, okay, then it becomes an equity. Okay, now we come to classification of financial assets. Okay, so in classification of financial assets also, there is a fair value option. Okay, you can designate all your financial, you can designate some of your financial assets, okay, at fair value through profit or loss. Okay, but again, that designation is not an open choice. Okay, you cannot say, okay, this I designate and this I don't designate. It's not an open choice. It is again restricted that only if it eliminates or significantly reduces the accounting mismatch. Again, the same concept that you have some financial, you have some derivative, okay, which is a financial liability, which is measured at fair value through profit or loss. Okay, we saw the exception that financial liabilities are this exception is that all financial liabilities are measured at amortized cost, but certain are mandatorily measured at fair value through profit or loss. So let's say you have a derivative, or you have a contingent consideration in business combination, okay, which you have to mandatorily measure at fair value through profit or loss. But against that financial liability, you have a financial asset, okay, linked financial asset. That financial asset is basically meeting the conditions to be measured at amortized cost. Okay, so what you do if you don't have this option, then there will be a mismatch. One I measure at amortized cost and one I measure at fair value through profit or loss. So that will be a mismatch, and that will impact my profit loss. And that is not the way I manage my business. Again, so here the standard says, okay, in that case, you can designate that financial asset at fair value through profit or loss. But only if that is there. If that is not there, you cannot. Okay. So, if I don't designate any financial asset at fair value through profit or loss, then basically there are two conditions for classification. One is the contractual cash flow condition and one is a business model condition. And depending on the satisfaction or meeting of these conditions, okay, the contractual cash flow SPPI condition and the business model condition, I have to classify the financial asset either at amortized cost or at FEOCI, that is fair value through other comprehensive income, or at fair value through profit or loss. So how is that done? So if the business model is the objective of the business model is to hold the financial asset in order to collect contractual cash flows. So basically I have let's say a fixed deposit, okay, in a bank. Okay, so what is your objective? You hold it till it matures. Okay, you don't sell those fixed deposits. Okay, or you have invested in a debenture or a bond, and but though the bond is or debenture is listed in the debt market, the entity has no intention to sell that. It basically has invested the money in that debenture or bond to collect the interest, and on maturity the principal. Okay, so the business model is not to sell, and I don't take fair value option. Okay, and financial asset has a contractual term of solely payment of principal and interest on the principal amount. What does that mean? Basically, we will understand what it means in further slides in detail. But here I will just tell you that solely payment is just like a loan. Okay, when you take a loan from a financial institution, so let's say a home loan, vehicle loan, what it has, a vehicle loan. Okay, so against that vehicle, okay, they give you an amount. Okay, and you have to repay that amount in equated monthly installments, which includes interest, okay, and principal. So if any contract has a term which has solely payments of principal and interest on the principal amount on the specified dates, then it meets the SPPI test. Okay, so if that SPPI test is met and the business model is to hold the asset in order to collect contractual cash flows and not to sell, then you have to mandatorily measure at amortized cost. You have no option, because you have not taken this option. Okay, you have this if it does not reduce any mismatch or eliminate any mismatch, accounting mismatch, you have to mandatorily measure such a financial instrument, a financial asset as at amortized cost. Okay, and now if both criteria is met, that is solely payment at the contractual terms, that it evidences solely payments of principal and interest and nothing else. Okay, there is no other element involved in that. And the business model is the objective is to hold in order to collect contractual cash flows, but the entity may also sell. Okay, so therefore the business model here changes slightly. The business model is not only to hold, to collect contractual cash flow. So same entity can have a different investment in a different bond or debenture, okay, which it intends to sell if there is any benefit available, okay, to the entity. Then in that case, that bond or debenture is measured mandatorily at fair value through other comprehensive income. Okay, it is not measured at amortized cost, it is measured at fair value through other comprehensive income. So fair value through other comprehensive income means you recognize all the changes in fair value in other comprehensive income and not in profit or loss. Okay, so you recognize all the fair value changes in other comprehensive income, but because this is a debt instrument which evidences solely payment of principal and interest, it is not an equity instrument, this is a debt instrument which has only payment of principal and interest. So therefore this particular thing, this mandatorily the instruments that are mandatorily measured at FEOCI are follow a dual measurement model. So the interest is recognized in profit or loss, whereas the fair value changes are recognized in OCI. So there is a dual measurement happening for such instruments. Okay, because we are not discussing measurement here, so we will not go into that. Otherwise, that will take a lot of time. And now this was for debt instrument. So for debt instrument, as I said, for financial asset also, you have to see whether it's a debt or an equity. If it is a debt and I have not taken a fair value option, then either mandatorily I measure at amortized cost or mandatorily measure at FEOCI. based on these two conditions, meeting of these two conditions. But if it is an equity investment, okay, the financial asset is equity, okay, then I have an option to designate that equity investment at fair value through other comprehensive income. This is an option, okay, but that equity instrument should not be held for trading. So this option is the intention of the standard is that for long-term investments, strategic investments, okay, where the company is not interested in the regular day-to-day fair value changes of those equity investments. So why to impact profit loss by those fair value changes? So if we impact profit loss by those fair value changes, it will not represent the way I manage my business again, because I am not holding these equity investments for fair value gains. It is a strategic investment, long-term investment. Okay. So then I can opt to recognize the fair value changes. Okay. In OCI. Now, in equity investments, this condition will never be satisfied, because equity does not have a solely payment of principal and interest. Okay. So therefore, the question of why equity is not measured at amortized cost or at FEOCA mandatorily, that does not arise, because this condition itself is not met for equity. Okay. So when the moment I have a financial asset and the moment the financial asset is equity, these two measurement is gone. Okay. This mandatory aspect is gone. I have either optional. I have the option to measure at FVOCI, and if I take that option, then all fair value gains and losses are measured in other comprehensive income, even on sale. Even on sale, I have to keep it in OCI. I cannot recognize those gains losses in profit. And if I don't take the option for equity investment, or if any of the debt investment, okay, do not meet any of these conditions, this classification criteria, then I have to mandatorily measure at fair value through profit or loss. So this is a RECI theory. So whatever does not fall in these three, okay, falls here automatically. Okay, so this is the way the classification of financial asset happens.
Sorry, can I ask you?
Yes, yes.
Sorry, see, when you measure an equity investment at fair value through OCI, right? And you sell that instrument, say 10 years down the line, right?
Okay.
And then gain or loss, shouldn't it be recycled through the income statement? Because see, what happens is that it gets washed into the retained earnings, right? Probably you will have your statement of changes in equity, a column as other comprehensive income. Then you have one line item saying that moves from OCI into retained earnings. Because to me, it looks baffling, because see, you have sold that asset, right? Your gain or loss shouldn't ideally be coming as part of your income statement. You might say that, no, my objective is to hold for long term. Intention is securities.
Yes,
all
so I understand your question, and this was the main issue when this standard was being developed, this particular requirement, where this is in paragraph 4.1.2a of IndAS 109. So when we say 2a, that means originally it was not there. So they had to insert between 4.1.2 and 4.1.3 this particular requirement as 4.1.2a. Okay, so there's a subsequent insertion in the standard, but because IndAS has come after the entire IFRS 9 was issued but not effective. We made it effective. IndAS 109. We are the early adopters of IFRS 9. So India should be, we are very proud that we are early adopters of this standard. So basically this particular option was inserted considering the comments of insurance companies that insurance companies manage their financial assets based on the financial liabilities. Okay, so normally company in other cases, what happens, the financial liabilities are managed in the way I have a financial asset or other assets. Okay, I manage my liability based on the assets, whereas in insurance companies, because they are into the business of taking a liability from the customer, so they have to first see the liability and then manage the liability based on the assets. Okay, so based on the liabilities, they have to manage the asset. So that is how it's a reverse situation for them. So for that, actually recognizing all gains and losses in profit or loss was not proper, because then if there is an insurance contract, okay, which is a long-term contract, and against that they have any mutual fund or anything, okay, they have an investment, okay, not mutual fund, they have invested in some share, okay, and for to manage that liability. Let's say it's a life insurance contract, so it's a very long-term one. So recognizing the every year fair value gains losses in profit loss is not proper. So now what is the option? So the option is that you take to OCI. Then now if I take to OCI, then the challenge is that whether to impair that instrument or not. Okay, because if you know IAS 39, okay, in IAS 39 there was a classification category called available for sale. Okay, in whenever any financial asset which was classified as available for sale, again what happened was the interest was recognized in profit loss, fair value was recognized in OCI. Okay, and but the asset was also tested for impairment on incurred loss model. It was tested for impairment, and then you recognize the impairment in your profit loss. Okay, so therefore the challenge is that should I impair? So now in 2008 financial crisis, what happened is it was difficult for users to understand whether the loss was of fair value or whether the loss was of whether the loss was a recycled fair value loss or whether the loss was an impairment loss. So there was that sort of, so because of that, so they have now restricted this to that you take this entire thing to OCI only. You don't recycle it, because if you recycle it, I have to also test it for impairment. If I test it for impairment, then whether that fair value loss is an impairment loss or a fair value loss, because I am measuring the instrument at fair value. Any loss is an fair value loss. So that's why this mandatory condition was there as an anti-abuse and also for ease of understanding of user.
So my question was upon disposal, right? So the question of impairment wouldn't arise, right? When you're disposed of the asset. So you realize your asset, right?
That's
I'll
what
tell
I.
you. No, well,
Let me explain you again. I think
yeah.
you have not understood what I wanted to say. I
No,
wanted
no,
to say that
I get your point.
had
Yeah, I get your point. Yeah, go ahead,
no,
please. Yeah.
had this recycling option been given, okay,
Hmm.
had this standard said that you may recycle the gain loss, okay, at the time of derecognition, then the standard will also be required to say that okay, how to recognize the impairment loss in profit loss. In that case, again, the 2008 issue, the financial crisis issue of available for sale will arise. That okay, whether the loss is an impairment loss or fair value loss, what is there? So they are saying no, you don't recycle this to profit loss. You keep this in OCI, and when you dispose, you take it to retainer.
Okay, because my concern was with the investment company, which has a huge gain on disposal, but they have washed it into the retained earnings. To me, it's very baffling. Everything goes on substance on form, right? Over form. So I can understand for an insurance company where you have financial assets and the financial liability, this entity washed about 20,000 crores into the retained earnings, the gain on disposal, just with a footnote and an accounting policy saying that you recognize in OCI and that's it. Upon disposal, it
Then
gets moved.
it is okay. If that such is the financial reporting, then I am afraid that they have not complied with IndAS 107 financial instruments disclosure. Because when any entity de-recognizes an instrument which is equity investment, which is classified as at FVOCI, it has to give reasons for de-recognition. Why
So
do you recognize?
they sold the
Okay.
instrument. So the gain was recycled within the statement of changes in equity rather than going through.
Yes, that's okay. But then the reasons have to be disclosed. It cannot. They cannot keep silent by this. They have to disclose why they have de-recognized. Because if
policy, that the accounting policy is that's how they do.
That is not sufficient. Accounting policies, you see, you go to our accounting policy repository. There are we have 7,000 accounting policies in our accounting policy repository. And none of the accounting policy is entity specific. Okay. They are so general that, okay, the standard gives us an option to designate any equity investment at FVOCI, but then they are not saying that okay, this year we have de-recognized and why we what were the reasons for the de-recognition. So accounting policy, this has to come in the note then.
Okay, fine.
I'll look. In the interest of time, may I request all the participants, I'll share your mail ID and mobile number. You can reply in detail for all any specific queries. Since we are past our allotted time, I request the members to note down the mail ID and phone number, and because the accountant discussion can go on, there are very subjective elements. So I would really urge you to mail to Mr. Manish Iyer. I'm sure he will find time to answer you without any this thing. So that
I would like to, if I can come in, Arun. We have a portal, gapadvisors.com. In that portal, anyone can register for free and submit their issues on IndAS and Indian GAAP. We respond to those issues, and 4,000 plus issues and responses we have already it is there in issue repository. So when you register, you get 48 hours of subscription access for free. So you can see that from that repository whether there is any answer for your issue. If it is not there, you can submit your issue. Yeah, so we will respond to that. So there is a structured mechanism available for issue and response. Okay. Because in mail, what happens is there will then be a number of mails, and then it will not be a structured one as such.
I just would like to recall the mission of GAAP advisors. It is to create collaborative technical cell of small and medium firms of chartered accountants who audit the financial statements of any company prepared and presented in accordance with financial reporting standards such as Indian GAAP and IndAS, that will provide expert services on financial reporting standards at the cost of a beginner. Second mission, to spread the knowledge and awareness of financial reporting standards such as Indian GAAP and IndAS among an organization using Indian GAAP and IndAS. So, to reiterate the request of Shri, I urge you to visit gapadvisors.com and make full use of whatever resources available for free, and very little is available for paid basis. On expert questions, I have used the service of Shri Manish Iyer earlier, and I am amazed to see that he is continuously offering bonanzas. He must be having deep pocket. So I urge others, if you answer correctly, you get a prize. So I expect the participants to, take advantage of it and make it paying for you. With this, I request that we conclude, because there is a time constraint. We need to close the session beyond. Though we started late, we are already 1.5 hours. I think a lot of time.
So
60 minutes. Kindly,
I will share this PPT, and we may have discussion some further days.
Yes, we'll have another program, another session, and then we'll probably get the questions in advance and probably have it as a different Q&A type instead of focusing on a particular thing. But of the nearly thousands of hours of Manish has been preparing that portal. So even though he may not be able to reel off in such a quick fashion on recall basis of all those type of scenarios, the portal will be able to support us accountants and all of us in this endeavor to become better accountants. So I take the I thank Shri Manish wholeheartedly for holding us without interruption for such a long time. I look forward